All right, let's dive into this exciting world of Southeast Asian internet companies. Big names, big growth, big competition.
Yeah, we're talking companies like Sea Limited, parent company of Shopee, and, of course, Grab.
Battling it out in a region where, well, the digital economy is just exploding. Recent report from JP Morgan packed with insights.
Yeah, tons of great insights into what's driving this growth and where it's headed.
No crystal ball, but hey, JP Morgan's pretty darn close. So give me the highlights.
Well, first thing that pops out is their take on Sea Limited. They're predicting, get this, serious earnings growth.
Okay, I'm listening.
Largely fueled by Shopee's e-commerce dominance.
Shopee, the crown jewel, eh? What's the secret sauce?
Well, it's interesting, actually. They're not just playing the price war game.
Oh.
Shopee's GMV, that's gross merchandise value, is growing like crazy.
As in?
As in, it's outpacing the entire industry.
Outpacing the whole market.
Mm.
That's impressive. How are they pulling that off?
Take rates.
Take rates.
Yeah. Think of it like this. Every time you buy something on Shopee, they take a little cut.
Okay, got it.
And JP Morgan, they found that Shopee's been steadily increasing these rates.
Interesting. Across, like, all their markets.
Key markets, yeah. Singapore, Indonesia, Malaysia, the whole shebang.
So break this down for me.
Why are these increases such a big deal?
Yeah, why?
Because it signals a shift, you see, from growth at all costs to, well, a profit-driven model.
Makes sense.
They're focused on making money from their market share, not just grabbing more.
Using to investors' ears.
Absolutely.
Now, what about Garena?
Garena.
Sea Limited's gaming arm, right. Same bright future.
It's a bit of a different story.
Uh-oh.
They're heavily reliant on, well, a single game.
Which is?
Free Fire.
Okay, I've heard of it.
And JP Morgan, they do acknowledge this is a risk.
All your eggs in one basket, as they say.
Mm-hmm.
What if Free Fire fizzles out?
That's the question, isn't it? But JP Morgan also points out Free Fire is still a massive download hit.
Right, but how sustainable is that?
Well, that's where network effects come in.
Okay, explain.
Imagine a party, right? It gets bigger and better as more people show up.
Okay, I'm with you.
That's Free Fire. More players, more value for each player.
So the more popular it is, the more popular it gets.
Exactly.
Still feels a bit risky, this single game thing.
I get it. But JP Morgan thinks the market might be undervaluing Garena because of this perceived risk.
So opportunity for a savvy investor.
Potentially, yeah. Weigh those risks and rewards.
Right, makes sense. Okay, so Shopee's racking up profits. Garena's riding the network effect wave. What about Grab, the Uber of Southeast Asia, right?
That's a good way to put it.
What's their story?
Fascinating, really. They've achieved massive scale with this super app approach.
Offering everything, right?
Ride-hailing, food delivery, you name it.
But how do they grow from here?
The million-dollar question.
Right. Everyone's already using Grab, it seems.
Well, JP Morgan highlights their focus on MTUs.
MTUs.
Monthly transacting users.
Got it. So how are they growing that?
It's a combo.
Lay it on me.
Expanding into smaller cities, more affordable options, and also rolling out premium offerings targeting higher spenders.
Oh, covering all the bases.
Exactly. And to make it all work, they're investing in efficient delivery systems.
So they're casting a wider net and making sure the net doesn't break.
You got it.
Okay, so we've got Shopee with the take rate hikes, Garena betting on network effects, and Grab, well, they're doing a bit of everything.
It paints a picture, doesn't it?
Of a very dynamic, very competitive landscape.
It does. And if we zoom out a bit, there's a bigger trend emerging.
Ooh, I love those.
Remember those Shopee take rate increases?
Yeah.
Not the only ones doing it.
Really?
Grab's raising theirs too, and it's across the industry, actually.
So it's bigger than just these individual companies.
Much bigger. The take rate phenomenon is a symptom, a shift in the ASEAN internet sector, growth at all costs, to sustainable profitability.
They've been investing heavily for years, right?
Exactly. Pouring money into expansion, marketing.
Now it's time to see a return.
Precisely. And this shift, it has implications, investors for sure, but for consumers too.
How so?
Well, that's the million-dollar question, isn't it? And it's something JP Morgan dives into. We'll dig into that next, along with some other fascinating insights. Stay tuned.
So before we got sidetracked, we were talking about this big shift.
Right, in the ASEAN internet landscape.
Shopee, Grab, no longer just chasing growth, but focused on turning that growth into, well, profit.
Exactly, and as we were saying, This has implications.
For everyday consumers.
Like you and me.
Yeah, that's what I'm thinking about. What happens when these platforms just keep raising their take rates?
That's the big question. One that JP Morgan explores, actually.
Okay, I'm all ears.
They ask, will consumers end up footing the bill with higher prices?
Now, that's a good question. I'd be a little annoyed, I gotta say, if my Grab food orders started getting more expensive.
Exactly, and it's not just individual consumers. JP Morgan points out, rising take rates could create a barrier smaller companies trying to break into the market.
Harder to compete when the big players are taking a bigger cut.
You got it.
So it's a double-edged sword, huh?
Kinda, yeah.
Higher prices for consumers, potentially, and a less competitive market overall,
But could there be a silver lining?
Okay, I like where this is going.
Maybe this creates an opening for new niche players.
Interesting.
Companies that focus on specific needs.
Needs that the big super apps might overlook.
Exactly.
I mean, we've seen it happen in other markets.
Right. Think about it.
A new platform pops up, specializes in something specific.
Sustainable fashion, maybe.
Or caters to, like, elderly users who aren't comfortable with the big super apps.
There's always room for innovation.
And sometimes a changing landscape, well, it creates opportunities.
Absolutely.
Okay, so potential downsides, maybe some upsides too.
It all depends on how things play out.
All right, let's get into some specifics. JP Morgan provided some interesting data, right?
It did, yeah.
Comparing take rates across different platforms. What stood out to you?
Well, aside from confirming that, yes, take rates are rising across the board,
Right.
I was struck by the comparison
Between Shopee and Lazada.
Alibaba's Southeast Asian platform.
Right. Shopee's take rates seem to be consistently higher.
Interesting, particularly in, like, Malaysia.
Yes, Malaysia especially.
Why do you think that is?
Well, probably a combination of things.
Such as?
Shopee's built a strong brand, and they've invested heavily in logistics.
Okay. Infrastructure.
Right, and that gives them an advantage.
So they can justify a higher take rate.
Potentially, yeah.
It's not just about taking a bigger cut. It's about offering a better overall experience.
Exactly, and they're targeting a wider range of consumers.
So appealing to a wide range of sellers and buyers.
Now, back to Garena for a sec. We talked about the risks of relying on free fire. But JP Morgan seems pretty bullish despite that.
They do, yeah.
Even suggesting the market is undervaluing Garena. What's their reasoning there?
Well, it hinges on network effects.
Right, that self-reinforcing cycle of growth.
Exactly. As long as Free Fire keeps attracting new players, the game remains incredibly valuable.
But what if that momentum stalls? What if a new game comes along?
It's a risk, for sure. And that's why diversification is so important.
So Garena needs a plan B.
You got it.
Can't just ride the Free Fire wave forever.
They need to build a sustainable gaming empire.
Long-term success depends on innovation.
And evolution.
Okay, so current numbers look good for Garena, but their future, well, that's a bit more uncertain.
A challenge they'll need to face head-on.
Now, JP Morgan gets into some pretty deep financial details.
They do.
They talk about Sea Limited's projected earnings growth and a significant increase in their adjusted EBITDA margin.
Right.
I gotta admit, that one went over my head.
It's a mouthful, for sure.
Can you break it down for us non-finance folks?
Sure. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Oh, cool.
Basically, it measures a company's profitability.
From their core operations.
Exactly.
So strips away the jargon, tells us how much money they're actually making.
Pretty much.
And what's important here is Sea Limited's adjusted EBITDA margin is rising.
Which is
just becoming more efficient at turning revenue into profit.
You got it.
So it's a good sign. Their focus on profitability is working.
It is. They're not just growing, they're growing sustainably.
Attractive to investors.
Very much so.
And this ties back to those take rate increases.
Right.
By adjusting their take rates, they're boosting their profitability.
Which is reflected in that rising EBITDA margin.
Makes sense. It's all connected. Now, there's another term JP Morgan highlights. Sea Limited's cash flow from operations.
Yeah, that's an important one.
What does that tell us?
Think of it as the lifeblood of a business, the cash they generate from their normal activities.
Okay, like their day-to-day.
Exactly. A strong cash flow means Sea Limited can keep things running, invest in growth, even pay off debts.
Without needing outside help.
Right, like having a healthy savings account.
Not just spending money, but generating it.
Exactly, and that's what makes their story compelling.
Rapid growth and the cash flow to sustain it.
Powerful combination.
All right, we've covered a lot here.
You have.
Broad trends, specific metrics. But there's one more point from the report.
Oh.
They talk about Sea Limited's capital expenditure.
CapEx.
Yeah, what is that exactly?
It refers to the money a company spends on acquiring or upgrading physical assets, buildings, equipment.
Or in Sea Limited's case, investments in their logistics network.
Could be, yeah.
So it's like investing in a new oven, if you're a bakery.
I like that analogy.
Spend money to make money.
Exactly.
And what JP Morgan highlights is, Sea Limited's been managing their CapEx strategically.
Keeping it stable relative to their sales.
So they're being disciplined.
Even as they pursue growth.
Finding that balance, right?
Exactly. Investing for the future without going overboard.
Key takeaway,
But
right?
he thinks
We're seeing a shift from breakneck growth to a more mature, profit-driven approach.
companies are getting more strategic.
Looking for sustainable ways to make money.
And navigating a complex regulatory environment.
All right, folks, that wraps up our deep dive into the ASEAN internet landscape. Big thanks to JP Morgan for their insightful analysis.
Great report.
We explore the growth, the strategic moves, the potential risks, and the broader trends shaping this dynamic region.
It's fascinating, isn't it?
But, as always, the conversation doesn't end here.
Keep learning, keep exploring.
Stay curious, and stay tuned for more deep dives into the story shaping our digital future.